In Chapter 14, we're going to talk about different types of financing. This is an adjustable rate mortgage, and an adjustable rate mortgage is really just what it sounds like. The rate adjusts. It can change. It can go up. It can go down. It can rise. It can fall with changes in whatever the prevailing interest rate is. Now, there are some benefits to having an adjustable rate mortgage. Initially, they will give you a teaser rate. That's what they call it. The initial rate is lower than what you would get on a typical fixed rate mortgage. And so that's enticing for a lot of people who are interested in saving a little bit of money. But if the interest rate goes up, then after your initial first rate change, you're going to see a significant difference in your payments. So even though they tease you a little bit to get you into the loan, a lot of times there are a lot of negatives that can go along with it. If the interest rate rises, your payment's going to go up. That means your payment amount is going to change, and most of the time it's going to increase. Here we have several different terms that go along with adjustable rate mortgages. So we have the interest rate, we have the margin, the adjustment period, the interest rate cap, the payment cap, negative amortization, and also disclosures that go along with it. So we're going to look at each one of these. So the first term here is the interest rate. So that is going to be the rate that is quoted to you for the adjustable rate mortgage when you first start out. Now keep in mind it is an adjustable rate, so it can change. We also have the margin. The margin is going to be the lender's cost of doing business. It can be anywhere from 2 to 3% depending on the loan, and the margin is added to the index rate. Now the margin is how the lender makes their money. So whenever you hear about the Fed cutting rates to 1%, the margin is the reason why you're not going to get a mortgage loan at 1%, because the lender is going to have to make some money off of you. So right now, at the time of the recording of this, it's April the 4th, 2020, and interest rates are around 4, 4.25. And the Fed recently lowered the rate significantly to right around 1 or under 1. So a lot of people were like, well, I can go out and get a mortgage for that. No, it doesn't work that way, because the lender has to have something that they tack onto it, which is what they call their margin, so that they can make money too. And then we have the adjustment period. So this is the amount of time between changes in the rate. The most common adjustment period is going to be 1 year, or it could be 6 months, but the most common is 1 year. So what happens is you have a specific amount that they're quoted to you, and then you're going to have an adjustment of the adjustable rate mortgage, and it's going to happen within that 1 year time frame. It can adjust up or it can adjust down. The scary part is when it adjusts up. One of the things that you'll see with an adjustable rate mortgage is an interest rate cap. So they actually do put a cap, or what they call a ceiling, on the amount that the rate can actually go up. So here's how this works. If you have an adjustable rate mortgage, for instance, that has a cap of 1 in 6, when you first start out, you will have an adjustment period, usually within the first year of having the loan. So the 1 that's indicated here on the slide is going to be the amount that the rate could increase at that first adjustment period. So if you start out at, say, 4% and you have a cap of 1 in 6, the very first adjustment can only go up 1 percentage point from where you started. So if you start at 4, it can only increase to 5. Now the second number here, where you have a cap of 1 in 6, is 6. 6 indicates over the life of the loan, it can only go up 6 percentage points from where you started. So if you start out at 4, the maximum interest rate that you would see would be 4 plus 6 is 10. So with caps of 1 in 6, the highest it would ever go would be 10%. Now let me tell you, if you're starting out at 4 and you go up to 10, that is going to be a significant difference. Now we also have a payment cap. This limits the amount that your payment can rise. That's going to be that limit of that 10%. So keep in mind, whenever you're looking at an adjustable rate mortgage, which I don't recommend, by the way, there are caps, but the caps could be significantly higher from where you first originally start. In the House of Cards documentary, they talked about a specific type of loan called a pick your payment mortgage. Okay, This is beyond ridiculous, because what is happening in a scenario like that is you are choosing to pay only interest or even less than the interest that you owe on the mortgage, which means that over time you're actually increasing your mortgage balance. Okay? This is so bad, I can't even tell you. So negative amortization is when you're not decreasing your principal balance each month. It's actually going up. You're increasing your balance. This is not what we want to happen, okay? We want positive amortization, which means that every single time you make a payment, you have an amount that goes towards principal, you have an amount that goes towards interest, and with every payment that you make, you decrease the principal balance that you owe on the mortgage. There are disclosures that go along with adjustable rate mortgages. Regulation Z requires that creditors provide all of the information that goes along with the cost of the loan. We've talked about that before. They also have to disclose how the rate can change and how that could affect you, how that's going to affect your payments. There's also a Consumer Handbook on adjustable rate mortgages that you should receive if you ever apply for one. Let's look at some other types of financing that you might run into. So the first one here is a graduated payment mortgage. And this helps borrowers qualify for a loan by basing their repayment schedule on salary expectations. I'm expecting that I'm going to make considerably more money in the future, and so I might not can afford this gigantic, huge house right now, but I'm going to be able to afford it later. So let's set it up so that my payments are small to begin with, and then they'll increase. So I know you're thinking, why in the world would you do that? How do you know? Well, a good example of this would be, say, a doctor. Okay, when you're getting your degree, you're going to be a resident for a while, you're not making quite as much money, and then eventually you're going to be full-fledged, you're going to have your own practice, you're going to be making considerably more, right? And so in a situation like that, where you're doing your residency, you know that eventually your income is going to increase, a graduated payment mortgage might make sense for you. So in a situation like that, you have an interest rate and maturity, they're fixed, but the monthly payment is going to gradually rise because the initial monthly payments are insufficient to fully amortize the loan. So initially you're not doing all that great, but eventually the payments are going to catch up, and then you're going to be able to pay everything in full by the end of the loan term. Another type of financing here is equity sharing. This is where you have an agreement where one party provides financing and they also get a portion of ownership. So a good example of this would be, say you have an investor that's financing a shopping center. So because they're financing the shopping center, they also want to get a portion of the rental income or part of the profits that are coming in. So the person that is building the shopping center is sharing equity with the person who is providing the financing for it. The third type here is a rich uncle loan. This is a variation of equity sharing. A really good example of this would be where you have a parent who co-signs on a loan for a child. So I've talked a little bit in this class about FHA loans. I've given, I've sold a lot of different houses to students whose parents said, hey, let's go find you a house. I'll co-sign on the loan for you. We'll do an FHA mortgage because it's a small down payment, 3.5%, and the down payment can be a gift. And that is a really good example of a rich uncle loan. So the down payment with an FHA mortgage could come from grandma, it could come from your rich uncle, it could come from your parents. It doesn't really matter. And that's the reason why FHA mortgages are popular for this type of loan. Now let's talk about a package mortgage. A package mortgage is a mortgage that secures personal property along with real property. So I want you to think about it this way. Think about, say, a farmer who is selling his farm. If a farmer is selling his farm because he wants to move to the city for whatever reason, then he probably doesn't need all of that farm equipment anymore, does he? So a lot of times when you sell a farm, you also sell farm equipment that goes along with it. So I want you to think about a farm, and I want you to think about all of the tractors and combines and all of that personal property, all of that equipment that would go along with it. Picture that you have a really big box, okay? The farm is in the box, all of the equipment is in the box, and we're gonna wrap that up, put a big bow on it, and we're gonna call that a package mortgage. It's consisting of real property and personal property. Okay, so that's your visual. It's a big package with a big red bow. Now I'm saying that because a lot of times students get package mortgage and blanket mortgage confused. So I want you to have a visual of each one so that you can understand. A blanket mortgage, on the other hand, is when you have a mortgage that secures 2 or more properties, real properties. So picture a house on a lot and a vacant lot right next to it. Okay. Now the person who is buying the house also wants to purchase the vacant lot, which is next door, because they don't want a neighbor right next door to them. So they want to buy the house on the lot and the vacant lot right beside them. Okay. So we are going to get a mortgage that secures both of these properties. So picture a house on a lot, a vacant lot, and put a blanket over both of those properties. That is what we are going to call a blanket mortgage. Now keep in mind, a blanket mortgage can cover 2 or more. It could be 3 or 4 or 5, okay? But just think about a blanket covering that, and these are real properties that are being financed together. The last type here is a construction loan or an interim loan. So this is a short-term loan for when you're doing new construction, or it could be that you're doing an addition on a house or you're remodeling a house. So a construction loan is a short-term loan. And once you're complete with all of the construction, then you're going to have it permanently financed. Now here we have a reverse mortgage. You may have seen ads on television that talk about reverse mortgages. I think Tom Selleck is actually advertising reverse mortgages right now, if you know who that is. But reverse mortgages are primarily designed for people who are older. So you have to be at least 62. And also you need to have considerable equity in your property. So reverse mortgages convert your equity that you have basically into income. So if you have a lot of equity in your property, then you can get a reverse mortgage and they will actually pay you from the equity that you have in your house. So the homeowner borrows their equity and you can actually receive the payments in a couple of different ways. You could do it as a credit line where, say, you're taking out $50,000 worth of equity and you can pull on that credit line whenever you need it. But once you start pulling on the credit line, right, then you've already begun that mortgage. You can also have a regular annuity disbursement where every year you get a certain amount. And then you could also just do a lump sum disbursement where if you want to get $50,000 worth of equity out of the house, then you just get a 50-gram check. This is a really good visual on how a traditional mortgage works. When you make payments every single month, you're paying a portion towards interest and you're paying a portion towards principal. So you've got this girl, right, and she's pouring water into this house. That is an indication of the payment that she's making. And as she's making more payments, her equity, which is the water that you see that is rising in this house, her equity is increasing. And over a long period of time, you're going to have considerable equity in the house. So this is what a traditional mortgage is going to look like. Now with a reverse mortgage, we see the opposite of this. We already have a lot of equity in our house and now we're going to liquidate some of that equity. And we're going to get it either as a credit line, as an annual disbursement, however we decide that we want to get that money out. So this shows you that over time, even though you start out with a lot of equity, in the end you end up with less and less. Now here's the thing. With reverse mortgages, there are positives and there are negatives. Okay, I am of the opinion that a reverse mortgage is really only beneficial if it is a last resort for you. You know, as people get older, they start having more health problems. They have a lot of expenses associated with medicines and things like that. And sometimes the money that they had saved up for retirement just isn't enough. So if you're in a situation where you really don't have another choice, a reverse mortgage might be a good option for you. Here's what you have to keep in mind though. Whenever the person who has that reverse mortgage, if they move out of the house or if they die, okay, and usually because it's someone of an older age, they're going to pass away, the mortgage has to be paid back. So the equity that you take out of the house, you do have to pay it back in the end. So here would be my recommendation. If you have really good life insurance that would cover the equity that you're taking out so that when you do pass away, your family will receive that life insurance that can pay back this mortgage, then go for it. If you don't have life insurance, you're going to be sticking this reverse mortgage with your children. Now, if you don't have children, then I guess that's not an issue for you, right? Or maybe if you don't like your kids, that's a joke, right? But I guess what I would say more than anything is just be really cautious when it comes to this kind of thing, because nothing is free. They make it sound like it's really, really great, but keep in mind, nothing in this world is free. Now, this is another type of financing. This is a blended rate loan. And I'm going to be honest, I don't see these very often at all, but they can be offered by lenders to help in refinancing. So say you have a mortgage that has an original rate of 7%, and currently the rates have gone up to 12%. Now, you want to refinance for whatever reason you might need to do that, but you certainly don't want to do it at 12%. So you go to your bank and you say, listen, is there any way that we can maybe blend a rate, because I have a lot of equity in this property? So if you have considerable equity, they may actually consider giving you a blended rate loan where they might offer you 9% if you refinance instead of the full 12%. Equity loans. They talked about these in the House of Cards documentary, and there's several different types of home equity loans that you can get. If you have a lot of equity in your house and you want to take out some of that equity to make more improvements, that's typically when someone takes out a home equity loan. Say you've built up $50,000 worth of equity in your property and you want to put a swimming pool in the backyard. So you take out $35,000 and you put in the pool. Now keep in mind though, whenever you do a home equity loan, this is another loan. So you already have an existing mortgage, and now you have a home equity loan that you're also going to have to make a payment on. So now you're going to have two payments, okay? So keep that in mind. There's different types of home equity loans that you can get. You can get loans that are closed-ended, fixed-term loans, where they basically amortize it over, say, a 10-year time frame. That's usually what you see with a home equity line of credit. You can also have them that are open-ended. So you could say, hey, I want to take out 50 grand and I'm just going to use it as I need it. But once you start using it, you have to start paying it back. So once you initially take any money out of that loan, then you have to start making payments each month to pay it back. One of the reasons why people like these home equity lines of credit is because just like with a traditional mortgage, your interest is tax deductible. So with a home equity line of credit, your interest that you're paying is also tax deductible. So that can be a reason why people really like that. Here we have affordable housing loans. And affordable housing loans really is sort of an umbrella term that covers many slightly different loans that target first-time buyers and also low to moderate income borrowers. So in a lot of situations, these are people who are first-timers. They've never bought a house before. In a lot of scenarios, they are people who, quite frankly, really are not ready to buy a house. Okay? They have low down payment requirements. There is one loan in particular that's really popular. It's called Georgia Dream. So obviously it's only in Georgia, but it's designed to entice people to get into a mortgage. But in a lot of situations, guys, they're really not ready yet. You know, in the documentary that we watched, we saw a lot of people who had no idea about anything regarding loans. Okay? They basically took all of the advice that they got from their lenders. They listened to everything that they said. They took it at face value, but they didn't really do their research. You had a lot of people who lied on applications, and they didn't understand the ramifications of making those applications go through when they weren't being completely truthful. And so I'm very, very cautious about things like this because I don't want people who are not ready to own a home to get into a mortgage that they cannot handle. And that's what happens in a lot of situations. There are people who barely qualify. I mean, they barely get in by the skin of their teeth. And because of that, they're either going to be house poor or they're going to be in foreclosure in a very short period of time because they just are not ready. And there's nothing wrong with that. It takes a while to be financially prepared to own a property. It takes a while to understand how to financially manage your money so that you can afford a house. And a lot of people don't understand, when you buy a home, it's not just the mortgage payment. You also have to maintain the yard. You have to fix things as they break. And so there are a lot of responsibilities that go along with owning a home beyond just that mortgage payment. So I would just be really cautious about this type of mortgage. All right, so let's talk a little bit about seller financing. Seller financing is when you go directly to the seller and the seller finances the loan for you. So there's no bank involved, there's no lender involved. It's just you, the borrower, and the person who is selling the property. Other terms that you'll hear with regards to financing. The first one is subordination. So you can have a first mortgage, and then you can also have a junior mortgage, or you can have a first mortgage and you can have a home equity line of credit. The home equity line of credit or the junior mortgage are both going to be subordinate to your first mortgage. So that is what they refer to when they say subordination. That first mortgage, whichever one is filed first at the courthouse, is the one who's going to take highest priority. We also have a contract for deed. In the previous slide, I explained a little bit about seller financing, where you pay directly to the seller. Now, a seller is going to do this in some scenarios because, well, they can charge you a higher interest rate. And also, if you stop paying them, then they just take the property back, right? So you're leaving that middleman out, you're leaving the bank out, and it's just you and the seller. But the seller has major benefits of doing this for you, because not only do they get a higher interest rate and they have cash flow on the property, but if you stop paying, they can just take the property back. We also have options. In financing, you can have the option to, say, buy a house within a certain time frame. A lot of times you see options for a lease with an option to purchase. Options are just that, they're options. You do not have to exercise an option. If you decide not to move forward with the purchase, then there is no penalty associated with an option. We have rentals. The rental goes along with the lease with an option to buy. So in a lot of situations, you might have a tenant who is leasing a property and they want to purchase it, but they aren't qualified just yet. And so they might sign up for a lease with an option to purchase. I will say this, a lot of times when people do a lease with an option to purchase, it doesn't work out. And the reason for that is because a lot of times what will happen is someone will get into a house and they'll find all these things that they don't like about it. And so they'll decide not to actually purchase it. I mean, it might be things within the house itself. It could be the neighbors. It could turn out that they don't like the area that the house is in. And so in a lot of situations, it's kind of like a test run. And in most scenarios, it doesn't play out very well. And then we have creative financing. Creative financing, an example of that would be a contract for deed or seller financing. It's just a way to sort of, and I hate this terminology, but think outside the box, do something a little different, right? That is anything that is different from the ordinary financing through a lending institution in order for you to purchase a property. In the House of Cards documentary, they talked a lot about refinancing. And a lot of the people in those scenarios were getting a mortgage that was an adjustable rate, and their intention was within 3 to 4 to 5 years refinance to a fixed rate mortgage. A lot of times that didn't work out in that scenario, right? Because there were a lot of different factors to play, but people started foreclosing on houses because they could not meet the payments when the interest rates would rise with an adjustable rate mortgage. So then they would go into foreclosure. Then you would see lots of foreclosures in a particular area. And if you have a ton of them, then when an appraiser comes out to appraise property, he doesn't have an option not to use a foreclosure. And we know that foreclosures typically sell for less than market value. So that tanks the market. The market goes down, right? If the market has decreased, you're losing your equity. So now you can't refinance. All right, so that is the scenario that was going on in that entire documentary, and the reason why the housing market crashed. Now, let's talk a little bit about reasons why you would refinance. Okay, in a typical scenario, refinancing a mortgage sometimes is a really good option. There's lots of different reasons why you might want to refinance. If you have an adjustable rate mortgage, Don't you want something that is more reliable, like a fixed rate, so you know exactly what you've gotten yourself into, that there's no variation that could come along and surprise you? So switching from an adjustable rate to a fixed rate loan is a great reason to refinance. Another reason why people might refinance is to shorten the term of the loan. You may have started out with a 30-year mortgage, and now you're like, you know what, rates have decreased. Let me go in and shorten the term of that loan. Let me refinance it to a 15-year so I can pay it off faster, right? Another reason might be we can get a better interest rate. Maybe when you originally bought the house, it was at a 5% rate. Now you can get a 3% rate. So that's going to make a significant difference over the long run in the amount of interest that you're paying on that mortgage. So these are the most common reasons why you would refinance a property. You can get a lower rate, you can shorten the term of your loan, or maybe you can even get into a mortgage that's a better type. Now there's a little bit of math that you need to do to figure out if refinancing is going to make sense for you. Okay. Now, refinancing is an investment decision. You're comparing the benefit to the cost, because whenever you refinance a house, you still have closing costs associated with the refinance. So it is going to cost you something, but what is the benefit over the long term if you actually fork out the money to refinance? So what is the net benefit versus the cost to refinance? Let's look at an example. So here we have an example. We have an existing mortgage of $100,000. The remaining term is 15 years. The interest rate is 7%, and your monthly payment is $898.83. Now we have an option to refinance to a new mortgage, still $100,000, 15 years. The interest rate is 5.5%, and your new monthly payment is going to be $817.08. Now you're expecting that you're going to pay off this loan in 6 years, and the cost to refinance the property is going to be 5% of the loan amount. So how much money are we actually going to save? If the monthly payment reduction, if we're going from $898 to $817, that means we're going to save $81.75 every single month. Now we're planning to be in this house for 6 more years. So 12 months times 6 years, that's 72 months. So that means we're going to save $81.75 for 72 months. That's going to be a total of $5,886. Now keep in mind too, the cost of refinancing this property is 5% of the loan amount. The loan amount's $100,000. We're going to take 5% of that. That's $5,000. So the approximate net benefit of refinancing is going to be the amount you save over that monthly time frame, 72 months, $5,886 minus the cost of refinancing, your closing cost, that's $5,000. So the net benefit of refinancing in this example is $886. Now, it's up to you. For me, that's not enough money. Okay, I would not refinance for $886. Some people might. That's fine. Whatever works for you. But I'm going to tell you, when it comes to financing a property originally or refinancing a property, there's a lot that goes into it. You have to get a lot of information together. It takes a lot of time. It takes a lot of energy. It's not worth $886 to me. Okay, it might be to you, and that is perfectly fine. But at least now you have an idea of how to figure out whether or not it's worth it for you. So there are some personal costs of refinancing. It does take time. You have to get together a lot of information for the lenders. It can be very stressful for people who don't like that kind of thing, right? And if you're saving a significant amount of money, it's totally worth it. If you're not saving that much, then you might want to wait. So you just have to figure out on your own whether or not the amount that you're saving outweighs the stress that's involved with refinancing. Now, there is a refinancing rule of thumb. This is what we call the spread. I've always heard this from the day that I first started selling real estate, that if there is a 2% spread in the interest rate, so say you start out at 6 and now you could refinance at 4, then it's probably going to be worth it to you to refinance the property. Now, I have included a YouTube video that you guys can watch that goes along with this particular topic. And in that video, he talks about a 1% spread is typically worth it. So you guys know the formula now. You know how to figure out whether or not it's going to make sense for you. So it really just depends on the person, I think. But the general rule of thumb I've always heard is 2%, but he says 1%. So it's really up to you as to whether or not it's something that you want to do or not.